Okay, in this teaching module, we're going to talk about the introduction to price elasticity of demand using the overseas petroleum exporting countries as an example. So I'm going to introduce conceptually the idea of price elasticity of demand, and then we'll use a case study from OPEC to talk about that, about competitiveness in the market and short versus the long term, and the ability to substitute in and out of factors of production, and then how you model the economy and how you model competition. So the price elasticity of demand is the percent change in quantity demanded divided by the percent change in price. So the first example we'll be looking at is, let's say that a firm, a business entity, increases its price by 50%, and their revenues drop by 100%. That means the change in revenues is greater than the price change, which gives you absolute value of 2. So when the price elasticity of demand is greater than 1, as in this case, that means the firm is a price taker. And that approaches perfect competition when the firm is a price taker. And that's when therefore then that means that you have consumer sovereignty. In other words, the consumer is king. And that means you have competition. Individuals are able to exercise their preferences in the market. For example, if you want to reduce climate change, but solar panels are freely traded, well, then you have the right to, consumers have the right to exercise their voice in the market through the willingness and ability to pay in the market for things they value. But of course, we don't have free trade in solar panels because there's trade barriers against Chinese solar panels. So we don't have consumer sovereignty in the market to exercise your rights for climate change. Due to rent seeking on behalf of the American solar panel manufacturing companies. And that's been carried on. It started with Team Blue, these trade barriers against solar panels, and they continue through today, or under the previous Team Red administration through today, through the next Team Blue administration. Both Team Red and Team Blue put in trade barriers against solar panels, preventing free exit and entry, and giving above normal profits to the American solar panel manufacturers. So the other example then would be when a firm has pricing power. Instead of the firm being a price taker, the firm has pricing power, or they've got monopolistic power or monopolistic competition. In this case, the firm raises its price 50%, yet firm revenues only go down by 25%. And then the price elasticity of demand is less than 1, meaning the firm has pricing power. So we can look at this on the extreme examples, the Reducto ad absurdum argument. So this is the market for pizza in Sunset Park, Brooklyn. You'll see the demand curve is completely vertical. This means that if you have to buy this product in the market no matter what the price is. So price elasticity of demand approaches 0. The other extreme example is when the price elasticity of demand approaches infinity. So in general, you model a price elasticity of demand as 1, like this. 45-degree price elasticity of demand is equal to 1. So a purely inelastic demand is vertical, a purely elastic demand is horizontal, and then you draw the price elasticity of demand equal to 1 at a 45-degree angle. So what I mean to say when the price elasticity of demand approaches infinity, when the firm is a price taker, if the firm increases its price above the market clearing price, they'll lose all business. If they lower it below the market clearing price, they'll capture all business, but they won't be able to cover their overheads. And we'll look at that when we look at the Marshallian cost curves. So now we'll look at the applied example around OPEC, which helps us understand competition using the price elasticity of demand. Okay, we'll start with a Cartesian plane for a given market, however defined by whom and why. In this case, well, I pulled this from Mankew's textbook, but it's also a good way to explain competition in the short and long term. So we'll start by looking at the market for gasoline in 1973. I've drawn in the short term, at a given point in time, the price elasticity of demand is not as flexible as it would be in the long term, because the consumer isn't able to substitute in and out of goods because of status quo bias in their decision-making process. So I've drawn the demand curve with a price elasticity of demand less than 1. It's less than a 45-degree angle. And we're keeping supply at the price elasticity of supply equal to 1 in both cases. That's our numerator. And in the 1973 starting point of analysis, this is the consumer surplus. All of these people would have demanded more at a greater price. So what happens is the market clearing price is less than all of these people would have demanded. The price they would have been willing and able to pay a higher price than the market clearing price, which, by the way, is another example to show why GDP doesn't fully measure the economic welfare created in the market, because it doesn't capture consumer surplus. It only captures the market clearing price in the National Chart of Accounts. When they calculate GDP, it doesn't take into consideration consumer surplus. So here's the consumer surplus for gasoline in 1973, when the price elasticity of demand is less than 1 in the short term. So what happened, you had an Arab-Israel war in 1973. You had an Arab-Israel war, and the overseas petroleum exporting countries formed a cartel, mostly Arab countries. And Brazil is a big one, and Russia is a big one. But the OPEC countries decided to get together and reduce supply in order to penalize the West for supporting Israel in the Arab-Israel war. So they did that by reducing their output. So when you reduce the output, supply shifts back. And you get a lower quantity transacted. So all of this now, and at a higher price. So all of this is the lost consumer surplus with the first OPEC intervention. Then, believe it or not, there's another Arab-Israel war in 1978. And what happened between 1973 and 1978 is Japan's, due to the higher price of gasoline, consumers in the West wanted to substitute into more fuel-efficient cars. So you really didn't need fuel efficiency standards and don't need fuel efficiency standards because consumers want to substitute out into more fuel efficient cars, be it due to climate change or due to the higher price. So Japan starts importing in more fuel efficient cars. So then people over the 5-year period between 1973 and 1978, consumers are starting to think at the margin and realize gasoline is more expensive and substitute out of more energy inefficient cars into more energy efficient cars and other modes of transportation due to the price signal change. So in the longer term, in this case, between 73 and 78, you get now the demand for gasoline, the price elasticity of demand is greater than 1 as people are able to substitute in and out of fuel inefficient cars. So then you get another Arab-Israel war, and I'll try to draw the supply shift back the same. So here's the supply shifting back due to the OPEC reducing output. Here's the new quantity, it's lower quantity. And here's the new higher price. You'll see that the new change in higher price is less than it was in the first case because the price elasticity of demand is more flexible. And you'll see that the lost consumer surplus is less. So the harm done by the OPEC reducing output is less in the long term because the price elasticity of demand is greater than 1. So as long as you have factor mobilities, which allow people to substitute in and out of the factors of production, then you'll have more consumer sovereignty and more economic efficiency and less that monopolies can harm the economy. So again, in the short term, the price elasticity of demand will be less than 1, but as long as the state allows the factor mobility, well then in the long term, you're going to get consumer sovereignty. The example I wanted to give, again, you move from price elasticity, you move from the consumer, the firm having power, or in this case, the cartel having power at the expense of the consumer. You move from that situation to a long-term situation where you have consumer sovereignty and the firm is the price taker, as long as you have factor mobilities. But firms like to capture monopoly power and get above normal profits. So the example I wanted to give about that in this case is after the Japanese started exporting to the United States more fuel efficient cars, Ford Motor Company wanted to put on trade barriers against efficient Japanese cars in order for General Motors for Ford to be protected from competition. So preventing factor mobilities, preventing competition in order for Ford not to have Japanese car competition. And at the time, the chief economist at Ford was somebody by the name of William Niskanen. And William Niskanen was asked by the chairman, one of the Fords, to write a memo to the board of directors stating why it would be better to put on trade barriers. So that Ford could get above normal profits by being protected from competition. But Niskanen refused to do that. He wrote a memo that said, a common commitment to requesting special favors is a common commitment to refrain from stealing. In other words, I don't agree that we should put on trade barriers in order to get above normal profits. We should have consumer sovereignty and the free market. So Niskanen refused to write that memo, so he got fired by Ford Motor Company. Thank you. That completes our introduction to price elasticity of demand, the OPEC example.